Alright guys, time for another week ahead video. This week we'll cover the trading week from the 29th of March to the 2nd of April, and our attention will turn to the Canadian dollar. Now the CAD has enjoyed a solid run over the past couple of months, and it was one of the least affected risk currencies during the latest round of sell-offs we saw in other risk assets. And the reasons to like the CAD to the upside is still pretty much intact from a medium-term point of view. And we've also seen some short-term supporting factors coming online as well. Now, the Bank of Canada has been one of the least dovish central banks over the past couple of months. And as the recent data has mostly surprised to the upside for things like employment growth and inflation, it has sparked growing speculation that the BOC will move towards tapering their asset purchase program in the next few months. Now, that has seen a very fast steepening of the Canadian yield curve in line with that of the US, Australia and New Zealand, as markets are pricing in tighter monetary policy in the coming months, with some very hawkish participants actually calling for the very first tapering of the bank's QE program at the April BOC meeting. Now, on the virus front, the EU is actually ahead of Canada in terms of their vaccination program, and that of course is saying something because the European Union has really been struggling. But if we take a look at something like new cases numbers, Canada has been able to keep new cases relative to population much lower, which is another positive element, especially on the virus front for Canada. Now, the other positive was this week's announcement from BOC Deputy Governor Gravel that the bank is winding down some of its emergency market functioning programs, such as its main financing facility, as well as its assets purchase programs for commercial paper, corporate bonds, as well as provincial bonds. He further explained that the tapering will of course be gradual, but it did confirm the normalization expectations that the market has been looking forward to, and is the first major central bank to start winding down their very ultra easy policies following the pandemic fallout last year, of course. Now, the other main driver for the CAD has been the strong push in oil prices. The climb in oil has been nothing short of spectacular, with a massive gain of more than 80% from the November 2020 lows. And the upside has been driven due to a couple of factors: better supply and demand prospects, hopes of that global synchronized recovery, rising inflation, and until recently, a strong push lower in the US dollar. Now, over the past two sessions, the bull has had quite a few jarring sessions, to say the least, to the downside, seeing some steep price declines, some of the steepest going back all the way to September and November 2020. Now, some speculated that the main reason for the move to the downside was new virus numbers ticking up in Europe, the new announced virus restrictions that's put in place in Europe as well, obviously putting a little bit of a dampener in terms of demand expectations. But apart from that, there really wasn't any specific catalyst to blame for the massive run lower that we had in oil prices. It was mostly attributed, apart from of course the virus numbers, due to some profit taking and some deleveraging. Now, after pushing lower on Tuesday, oil prices got some reprieve, with reports that a massive container ship, of course, has been stuck in the Suez Canal. Now, the latest report was that the situation remains unchanged, i.e. it's still stuck. And the reason for the upside in oil from this specific story is obviously both on the supply and the demand side. On the supply side of the equation, the channel is a very important route for oil tankers, many of whom are stuck waiting to cross. From the demand side, those ships that are forced to basically reroute and go around Africa means bigger usage, which could of course be more supportive from a catalyst point of view on the demand side. Now, according to a Bloomberg article, salvagers are hoping for high tide and full moon to try and float the ship. And we saw some tugs that managed to shift the vessel about 29 meters on Saturday, and dredgers also freed its propellers from the canal's mud. And this will be a very interesting development to keep track of for oil prices, and obviously for the Canadian dollar in the week ahead as well. Now, that brings us to the week ahead, where the main focus point for the CAD will be the upcoming JMMC meeting, the OPEC meeting. We'll also be looking at oil volatility and of course the Suez Canal developments. Now, as we mentioned, the challenges at the Suez Canal will be in focus this week, as it has a meaningful impact in oil prices. Successful attempts to dislodge the boat will arguably lead to some knee-jerk downside in WTI, which can affect the CAD, and any announcements of failed attempts or bad news that basically pushes back the timeline that's expected to see the boat being freed, that'll of course be more positive catalyst catalyst for WTI as well as the Canadian dollar. Now, the other development we'll need to be keeping a very close eye on is, of course, oil volatility, or OVX. That's the line that you can see on this chart in the blue, which had a very peculiar spike into the close on Wednesday's session, with a spike going from 44 all the way up to 64. Now, similar type of moves in the OVX, company drops of about 14 and 15% back in September as well as November, compared to a mere 2% drop into the close on Wednesday and a further 5% drop on Thursday. Now, the move was very excessive without any real major catalyst to blame, but we did see an equally impressive push back to the downside again in OVX. But it did still remain in a short-term upward trending move. Now, for those of you that hasn't or don't really look at volatility indexes, whenever you have an upward trending move in a volatility index, that's normally bad for your underlying asset. And whenever you have a downward trending move in volatility, that's normally more supportive for your underlying asset. So the fact that we had that big push to the upside and then that big push to the downside push was positive, but we have been trending higher overall, which was, of course, a more of a negative. So from a volatility point of view, we had volatility signaling that we might see further downside in price, but now we've had that Suez Canal coming in from the supply side, obviously disrupting some of that. So we have been getting a little bit of a mixed signal, and that really explains why we have been trading very choppy in this past week, with volatilities, like we said, signaling possible downside, but of course from a supply point of view, signaling possible upside. Now, looking at OVX, Thursday's lower high as well as Friday's lower low in OVX, with WTI managing also to stay above that key 59 technical support. That could mean that the worst might be over for now for WTI. Obviously, we'll need to keep a close eye on the other events to watch as well, but volatility will definitely be on the forefront. We also need to watch out for the upcoming JMMC meeting on Thursday. Now, the cartel surprised markets earlier this month when they decided to roll over production cuts again due to lingering uncertainties. And going into this week's meeting, the question is whether we'll see another cautious stance with another rollover, or whether we'll see some production coming back with some tapering of those production cuts. Now, the consensus view right now is that recent developments will urge the cartel to once again roll over cuts. Reasons for this is, firstly, with the recent increase in virus cases as well as the newly announced lockdowns in Europe, the demand outlook has arguably worsened from the prior meeting, even if it's just transitory. Secondly, price action has been very unnerving, like we said, over the past 2 weeks, and the massive increase in volatility will not be something that OPEC will likely just look over. Thirdly, we have heard some possible concerns about increased production coming out of Iran as well as Libya, as well as the private drillers in the US on the shale side, and that does pose a wild card for the cartel in aiming to keep supply and demand in balance. So with all of this in mind, the markets are expecting another rollover, and that is currently the baseline expectation, with some saying that Russia and Kazakhstan might walk away with another small reduction in cuts. But others also saying that given all the recent volatility, the chances of a potential increase in cuts cannot be overlooked, and that of course will pose a wild card for the meeting for WTI and for CAD in the week ahead. So on the screen is a quick rundown of the possible sentiment shifts that you can use for your scenario planning in the week ahead. We currently do hold a medium-term bearish bias on the euro, as we explained in depth in our week ahead video last week, and also on the Japanese yen due to the medium-term bullish outlook for US 10-year government bond yields. And thus we will look to both euro CAD as well as the CAD yen in this week's scenario planning. Now, scenario 1 would be any potential bearish CAD outcomes. This breakdown highlights a couple of the factors we'll be watching. Firstly, is a potential big miss in GDP. Obviously not expecting that to really have an impact on WTI, but expecting that to impact the euro CAD and CAD yen. Also looking for potential OVX resumption of that upward trending move. If we do see that spike we had, or that move to the downside, was short-lived and we start trending higher, of course that'll be a negative input on WTI, and that can of course affect the CAD negatively. The other bearish outcome is news that the Suez Canal is unblocked. Obviously that is expected to see some knee-jerk downside in WTI, and of course see some downside in the Canadian dollar as well. And then if we do see OPEC reducing production cuts, especially sizable, not smaller ones like we had for Russia and Kazakhstan last time, but if we do see reductions in those production cuts without Saudi taking more voluntary cuts to make up for that, etc., that's also expected to see downside in WTI. And if that's the case, we'd expect to see upside in EuroCAD and downside in CAD yen. Turning to the bullish potential catalysts, obviously just the opposite, looking for a beat in GDP month over month, not expecting that to impact WTI, but expecting that to impact the CAD, obviously Euro CAD, CAD yen. Also on the bullish side, looking for OVX to drift and trend lower. So we had that drift to the downside, taking out that prior low. We do now have a lower high as well as a lower low. So we're possibly looking to take out these lows. If we do see a confirmation of that trend to the downside, that is just one more positive catalyst for WTI and obviously for the Canadian dollar as well. Otherwise, news that the Suez is blocked and it is extended. So right now the markets are looking for a potential unblocking to take place within the next day or so. If that doesn't happen and we see it's being extended, obviously that is expected to be more supportive for WTI, negative for Euro CAD, positive for CAD yen. And then if we do see OPEC coming out with a surprise increase in production cuts, that's going to be very positive for WTI. Expecting Euro CAD to sell off on the back of that and expecting some further upside for CAD yen. Do keep in mind, guys, that the possible bullish and bearish catalysts are not necessarily dependent on each other, and it's not ranked in order of importance. Every catalyst here is a potential bullish and a potential bearish catalyst in its own right. And if we combine it with other similar bearish and bullish catalysts, obviously the expected price reaction is expected to be a bigger impact in asset price movements. Keep in mind that the markets can always surprise in the way it reacts. So, these outcomes are not trade calls in any way. They're just there as a mere guide for what we would expect in the event of these various outcomes. And it's only intended as a guideline and framework for your own scenario planning in the week ahead.